What if I told you that even when your investments are going up, you could actually be losing money? That's exactly what happens during inflation. Groceries cost more. Rent goes up. Gas gets expensive. And suddenly, your money doesn't stretch as far as it used to. But what about your investments? What happens to your stocks? Your savings account? Your bonds? Your real estate? Today, I'm going to break down, step by step, exactly what happens to your investments during inflation and what smart investors do about it. What inflation actually does. Inflation simply means that prices rise over time, which reduces your purchasing power. If inflation is 5% per year, something that costs $100 today will cost $105 next year. Now here's the key idea. If your investments are not growing faster than inflation, you're losing purchasing power. And this is where many people get confused. If your savings account earns 2% interest but inflation is 5%, your real return is actually negative 3%. You're going backward, slowly. So inflation doesn't just make things expensive. It silently erodes your wealth. Now, let's look at how different investments react. 2. What happens to cash? Cash is the hardest hit during inflation. If your money is sitting in a regular savings account, earning very low interest, inflation steadily eats away at its value. Let's say you keep $10,000 in cash during 6% inflation. After 1 year, that money has the purchasing power of $9,400, and you didn't even see it happen. This is why investors say, cash is safe but not risk-free. During inflation, holding too much cash becomes expensive. Now let's talk about something a little more complex: bonds. What happens to bonds? Bonds typically struggle during rising inflation, especially fixed-rate bonds. Why? Because when inflation rises, central banks often raise interest rates to slow it down. In the US, that's done by the Federal Reserve. When new bonds are issued at higher interest rates, older bonds with lower rates become less attractive. That means their market value drops. So if you own bond funds, you might see prices decline during periods of rising inflation and rising interest rates. However, not all bonds suffer equally. Short-term bonds tend to hold up better. Inflation-protected bonds like TIPS are specifically designed to adjust with inflation. But traditional long-term fixed bonds, those can take a hit. Now let's move to the one people care about most. 4. What happens to stocks? Stocks are more complicated. In the short term, inflation can hurt stock prices, especially if it's unexpected or rising rapidly. Why? Because higher inflation often leads to higher interest rates. Higher rates increase borrowing costs for companies. That can reduce profits. Growth stocks, especially tech companies, are often hit the hardest because their valuations depend heavily on future earnings. However, over the long term, stocks have historically outpaced inflation. Why? Because businesses can raise prices. If inflation increases 5%, many companies increase the price of their goods or services. That helps protect revenue. Companies with strong pricing power, think consumer staples, energy companies, or dominant brands, often perform better during inflation. 5. What happens to real estate? Real estate often benefits from inflation. Here's why. As prices rise, property values tend to rise too. Construction becomes more expensive. Replacement costs increase. And landlords can raise rents over time. So rental property owners may see higher property values, higher rental income. Meanwhile, if you locked in a fixed-rate mortgage before inflation surged, something interesting happens. You're paying back your loan with cheaper dollars. Inflation reduces the real burden of fixed-rate debt. That's one reason real estate is often considered an inflation hedge. But what about other assets? Commodities and gold. Commodities, like oil, food, and metals, often rise during inflation because they are part of what's driving inflation in the first place. Gold is commonly viewed as an inflation hedge. Historically, during high inflation periods, gold has sometimes performed well because investors look for assets that can't be printed by central banks. But here's the truth. Gold doesn't always rise with inflation. Its performance can vary widely. Commodities can also be volatile. So while they may hedge inflation, they're not magic solutions. The big picture. Here's what really happens during inflation. Cash loses purchasing power. Bonds can struggle, especially long-term fixed ones. Stocks may dip short-term but often outpace inflation long-term. Real estate often benefits. Commodities can rise but are volatile. The key takeaway? Inflation doesn't destroy wealth evenly. The real risk isn't inflation itself. It's being unprepared for it. If you want more content like this, please like and subscribe. See you next time.